There is a distinct difference between a quiet market and a frozen one, and what occurred in London this morning was not peace. It was a blackout. The machinery of the silver trade did not simply tap the brakes. It seemingly vanished. Communications went unanswered, standard quotes evaporated, and the withdrawal mechanisms that usually flow like water suddenly hit a wall. One desperate industrial buyer attempted to secure immediate delivery by offering $200 per ounce, a figure astronomically higher than the spot price, and yet, he could not find a single seller willing to part with the metal. This is the reality of the situation we are facing. If London is the beating heart of the physical silver world, then today that heart skipped several beats. It was a Monday morning following the holiday break, a time when the chaotic symphony of trading usually resumes with vigor. The fixing windows, the volume spikes, the frantic exchange of contracts, all of it should have been visible. Instead, the charts were unnervingly flat, displaying the kind of artificial stillness that suggests a dam is holding back a catastrophic flood. I spent the morning reaching out to every contact I have in the ecosystem. I started with the governing body responsible for overseeing the bullion trade, expecting a receptionist or at least a redirection. I was met with a dead line. I moved on to the major trading desks, the massive firms that act as the central nervous system for vaulting and product flow. The phone rang more than 40 times before clicking over to a generic, full voicemail box. This pattern repeated itself across every channel: email, secure messaging apps, direct lines to vault operators. It was as if the entire city had been evacuated. But this was not a holiday. It was a standard trading day. The silence suggests that the pipelines of wholesale silver are clogged, and when the physical flow stops, the price displayed on your screen becomes nothing more than theater. You might ask why, if the shortage is this severe, the price isn't exploding upward. That is the right question, but it assumes we are watching a free market. What we are witnessing looks far more like containment. A natural market failure is chaotic and noisy. This was calculated and silent. It appears to be a coordinated stand down, a decision by the gatekeepers to freeze the system rather than allow the price to reveal the true extent of the scarcity. If the London market were to reprice silver honestly before the American markets opened, it would trigger a narrative collapse. Industrial giants would panic, ETF holders would demand answers, and the rush to convert paper contracts into physical metal would bring the entire structure down. To prevent this, the valve is shut. They starve the market of information to maintain the illusion of stability. The situation deepened when a new directive surfaced from a major storage facility. It wasn't a dramatic announcement, but a cold, bureaucratic note stating that withdrawal requests were being queued for compliance reviews. The most chilling part of the message was the clarification that this measure was not temporary. For those who believe they are safe because their holdings are allocated, this is a wake-up call. In this industry, ownership is often a legal concept rather than a physical reality. If a vault manager refuses to release your specific bars under the guise of market disruption, your property rights are effectively paused. You do not own silver. You own a claim on silver that you cannot enforce. This is how a modern default happens, not with soldiers at the gates, but with an email about updated policy. The implications of this extend far beyond the investment world and into the real economy. Factories and industrial supply chains operate on tight schedules. They do not hoard years of supply. I spoke with a procurement officer for a major solar manufacturer who revealed that they have merely 11 days of silver inventory remaining. If they cannot secure more material within that window, their facility shuts down, causing a cascade of layoffs and broken contracts. This is why he was authorized to bid any price necessary, even $200 an ounce, yet still came away empty-handed. This proves that the spot price is irrelevant when availability hits zero. The system is currently hiding the true market by refusing to quote it. Adding to the pressure, reports are emerging from Switzerland, the world's refining hub, indicating that export controls are tightening. If London cannot move vaulted silver and Switzerland cannot export refined bars, we are facing a global gridlock. This is where economics shifts into geopolitics. When nations realize that critical resources are running low, They stop caring about the market price and start prioritizing domestic security. This leads to hoarding and a fracturing of the global trade network. As we look toward the opening of the New York session, do not be distracted by the noise. The algorithms may try to paint the charts with sudden drops to shake out weak hands, hoping to convince you that there is no crisis. They want you to sell your paper claims to relieve the pressure on the physical supply. Do not be fooled by the official narrative. The true signal is not on the chart, it is in the excuses. Watch for delays in delivery, watch for the inability to secure large bars, and watch for the widening gap between the paper price and the cost of actual physical metal. If you cannot hold it in your hands, you are merely waiting in line for permission to own it. The silence in London is a warning. The gatekeepers are showing us exactly what they intend to do when the demand becomes too great. They will simply close the doors. The question you must answer for yourself is simple. If the industrial giants cannot get their hands on metal even at premium prices, what creates the value in your portfolio? Possessing the physical asset is the only true security when the paper promises begin to burn.